The S&P 500 just hit another all-time high, closing at 6156 on July 4th, 2025, and it's up more than 20% since April. But with the index soaring to these dizzying heights, one question is on every investor's mind. Is now the time to buy, or is it time to sell? In today's video, we're diving deep into the S&P 500's recent performance, the economic factors driving this rally, technical indicators, and what history tells us about investing at market peaks. By the end, you'll have a clear framework to make informed decisions. So, grab a notebook and let's get started. For those new to investing, the S&P 500 is a stock market index tracking the performance of 500 of the largest publicly traded companies in the U.S. It's considered the gold standard for gauging the health of the U.S. equity market, covering about 80% of the total market capitalization of U.S. companies. As of March 31, 2025, its aggregate market cap was over $49.8 trillion. The index is heavily weighted toward tech giants like Microsoft, Nvidia, and Apple, which together make up nearly 20% of its value. But why is the S&P 500 hitting record highs? Let's break it down. Since April 2025, the index has surged over 20%, driven by a combination of strong corporate earnings, optimism around tariff relief, and expectations of stable monetary policy. Posts on X highlight the bullish sentiment, with some analysts predicting even bigger moves if the index breaks through key resistance levels. However, not everyone is convinced this rally is sustainable. Let's explore the factors fueling this run and the risks that could derail it. First, let's look at the tailwinds pushing the S&P 500 to new heights. Corporate earnings growth. Wall Street analysts are upbeat about earnings, particularly in sectors like technology, communication services, consumer discretionary, and financials. According to a recent note from BMO Capital Markets, earnings estimates for these sectors are rebounding, and some believe they haven't fully recovered to reflect the current strength. Strong earnings are the backbone of any bull market, and Q1 2025 saw S&P 500 companies deliver record-breaking buybacks of $293 billion, boosting earnings per share. Tariff optimism. Earlier this year, fears of aggressive tariffs under the Trump administration weighed on markets. But recent developments, including a 90-day trade reprieve and signals of potential trade agreements, have eased those concerns. The effective U.S. tariff rate has dropped from a peak above 25% to about 14%, reducing uncertainty and boosting investor confidence. Economic resilience. Despite earlier worries about slowing GDP growth, economic forecasts are trending higher. The U.S. economy has weathered challenges like inflation, supply chain disruptions, and geopolitical tensions. Yet the S&P 500's average annual total return since 1957 remains above 10%. This resilience makes U.S. equities, particularly the S&P 500, a favorite among global investors. Market momentum. Technical analysts point to a strong bullish trend. The S&P 500 is trading within a rising channel since May 2025, with no immediate resistance in sight and support around 6,080 points. The Relative Strength Index, RSI, is above 70, signaling strong momentum, though it also raises concerns about overbought conditions. But here's the catch. Not all signs are rosy. Some analysts on X are warning of underlying weaknesses like poor market breadth, where only a handful of stocks are driving the index higher. Let's dive into the risks. While the S&P 500's climb is impressive, several red flags suggest caution. Overvaluation concerns. The S&P 500's price-to-sales ratio is near all-time highs, a level that typically signals stretched valuations. Historically, such elevated ratios require robust profit margins to justify, but margins are already at historic peaks. If earnings growth slows, these valuations could become unsustainable. Market breadth divergence. A recent post on X noted that 50% of S&P 500 stocks are trending lower, even as the index hits new highs. This lack of broad participation suggests the rally is driven by a few heavyweights, which could mask broader market weakness. Overbought signals. Bank of America recently warned that the S&P 500 is close to triggering a sell signal, based on technical indicators like the RSI being above 70. High RSI levels often precede corrections, especially for large-cap stocks. Policy uncertainty. While tariff fears have eased, they haven't disappeared. The Trump administration's trade policies, upcoming Federal Reserve FOMC minutes, and geopolitical tensions could reintroduce volatility. Additionally, some analysts predict rate cuts in the near future, which historically have led to market declines despite their bullish perception. Historical context. The S&P 500 has posted annual gains 70% of the time since 1926, but it's also experienced declines of over 30% in some years, with 5% of trading days resulting in record highs. Chasing the market at these levels can be risky. So, with these drivers and risks in mind, let's turn to technical analysis to see what the charts are telling us. Technical analysis can provide clues about where the S&P 500 might be headed next. Let's break down the key indicators. Trend and support/resistance. The S&P 500 is in a medium-term rising trend channel, signaling continued optimism. It's currently in a bullish leg, with no immediate resistance above 6,156. Support lies around 6,080, and a deeper correction could test the 5,700 level. Moving averages. The index is trading well above its 50-day and 200-day moving averages, a bullish sign. The moving average indicator has given a positive signal, though its lagging nature means some upside may already be priced in. RSI and momentum. The RSI is above 70, indicating strong momentum but also potential overbought conditions. Historically, high RSI levels for the S&P 500 have preceded pullbacks, though not always immediately. Fibonacci levels. Some analysts suggest the S&P 500 is approaching a Fibonacci extension target of 6,310, with longer-term projections as high as 7,000. However, overextension could signal a reversal. The technical picture is largely bullish, but the overbought signals and lack of market breadth are concerning. Next, let's explore historical patterns to understand what happens when the S&P 500 hits record highs. Deciding whether to buy or sell depends on your investment goals, risk tolerance, and time horizon. Let's evaluate both sides. Reasons to buy. Long-term growth. The S&P 500's historical 10.3% annual return makes it a solid choice for long-term investors. If you're investing for retirement or a multi-year horizon, buying now and holding through volatility could pay off. Dollar cost averaging. Investing a fixed amount regularly reduces the risk of buying at a peak. Historical data shows that pullbacks often lead to recoveries, rewarding patient investors. Bullish momentum. Technical indicators suggest the rally has room to run, with some analysts targeting 6,310 or even 7,000. Sectors like tech and financials are expected to continue driving gains. Reasons to sell. Overbought conditions. The high RSI and price-to-sales ratio suggest the market may be due for a correction. Bank of America's sell signal warning adds to the caution. Profit-taking. If you've ridden the rally since April, locking in gains could protect against a potential pullback, especially if market breadth continues to weaken. Short-term risks. Upcoming events like tariff deadlines and Fed policy decisions could spark volatility. If you're a short-term trader, waiting for a dip might offer better entry points. Balanced approach. For most investors, a hybrid strategy makes sense. Consider holding core S&P 500 positions through ETFs like SPY, VOO, or IVV, while keeping some cash on hand to buy during corrections. Diversifying into other asset classes like bonds or international equities can also reduce risk. Here's a step-by-step guide to navigate the S&P 500 at record highs. Assess your goals. Are you investing for the long term or short term? Long-term investors can afford to weather volatility, while short-term traders should focus on technical signals. Use dollar cost averaging. Invest a fixed amount regularly to reduce the impact of market swings. Monitor key indicators. Watch the RSI, moving averages, and market breadth for signs of a reversal. Tools like TradingView or Investing.com can help. Diversify. Balance S&P 500 exposure with bonds, international stocks, or alternative assets to mitigate risk. Stay informed. Keep an eye on economic data, Fed policy, and trade developments. Resources like Yahoo Finance and S&P Global provide real-time updates. Consider ETFs. Low-cost S&P 500 ETFs like VOO or IVV are more cost-effective than SPY. Before we wrap up, a quick word of caution. Trading involves risks, and past performance doesn't guarantee future results. Always consult a financial advisor before making investment decisions. The S&P 500's record highs are a testament to the strength of U.S. equities, but they also come with risks. Strong earnings, tariff relief, and bullish momentum are driving the rally, but overvaluation, poor market breadth, and policy uncertainties suggest caution. Whether you buy, sell, or hold depends on your strategy, but history shows that staying diversified and disciplined pays off over time. What's your take? Are you buying the S&P 500 at these levels, or are you waiting for a dip? Drop your thoughts in the comments below. Thanks for watching, and I'll see you in the next one.